Are you Italian?
I am full-blood Italian, yes.
Okay, so we have been accused credibly of having a little too much Italian on this podcast. So try to keep your hands together. Don't let them get going around and shit, okay? Welcome to the Futures Edge podcast. I'm Jim Murio. As always, the brains behind the operation, Bob Iacchino, our executive producer. And today we have Andrea Lamari, the general partner of Manhattan Venture Partners. Andrea, dogs or cats?
Dogs.
Do you have a dog?
2 dogs, 2 Bernedoodles.
What are their names?
Gatsby and Fitz.
Interesting. Do you consider yourself like a big literary, do you read a lot of the classics?
I absolutely used to. F. Scott Fitzgerald was an absolute debaucherous writer, which I really love about his past, but my dog Gatsby does look like he's wearing a black tuxedo, so it was very fitting for him.
Fantastic. My dog's Peyton, not named after one of the classics, named after a running back. So some old guy once said, "What, did you name your dog after Peyton Manning?" I'm like, I'm gonna name my dog after somebody else's quarterback. Are you out of your mind? Go grab an NFL history book, pal. Walter Payton.
Yes.
All right. And how do you like Puerto Rico so far?
I love Puerto Rico. So I will say this is absolutely an island of intelligent pirates, is what I like to say, because you really have to want to be here, because there are massive benefits to being a territory of the United States, right? You get all the laws and governance of the US, but you get a bit of the autonomy of a Caribbean island, right? So in terms of being able to be creative in terms of how you live, there are pros and cons, but the tax benefits are amazing. I would say the biggest con I face, which is just woe is me, is that the best nail salon is Walmart. So that's what I have to deal with.
Oh, no, my wife would have a big problem with that. That could almost be a deal breaker. Do you know Brent Johnson, by the way? He moved down there about a year ago, too. Santiago Capital is his Twitter and his hedge fund. Do you know him at all? He's a good guy.
I don't believe I do. I'll have to I'll look him up.
That's like, oh, you're from New York? Do you know Bob? Sorry about that. Yeah, I know it's a big island, right? Yeah. But anyway, so could you do me a favor? Can we spend like the first 5 minutes to talk about what Manhattan Venture Partners does? So tell me that, please.
Sure. So Manhattan Venture Partners is a late stage venture capital investment firm. So we invest in big tech companies once they've already pulled off $100 million in revenue. So that's one of our kind of chief characteristics. We're not talking about young startups out of a garage. We are talking about proven businesses that are about 2 to 4 years away from their IPO. And the types of companies are, quite frankly, a lot of the ones that are really pretty well named brands that we invest in. So companies like SpaceX and Twitter. So we've got the Elon camp in our portfolio. We've got the makers of Fortnite, the biggest video game in the world. That company that owns it is called Epic Games, a really big investment position for us. We're doing investments in AI, in logistics, in fintech, like companies like Plaid, which is a commercial kind of competitor to Stripe, and Klarna, which is the buy now, pay later solution for consumers. And so we're investing in companies that, have really strong backing from other VCs and saying, hey, let's really get in there before they go public. But I will say our strategy, and this is really what sets us apart, is we're investing in those companies by actually working with the executive teams of the businesses and usually structuring a type of program where we're actually buying the stock at a significant discount where it's relative to where all the other investors invested. So we're not always going into that next round of funding that you read about in the news. We're the ones that go in and say, hey, this company is kind of staying private longer than you probably expected. Could we work with any of your shareholders, whether they're employees or early investors who need some liquidity before the IPO? And then that's where we're investing our dollars, is heavily in that.
So I have 2 questions. The first one is, and if any of these questions are inappropriate, just pretend like I asked someone else. Where does your funding come from? Is it big investors invest in you, or is it, where is that? And the second one would be, Is it companies that you envision bringing them to IPO sometime soon?
Yeah. Yeah. So our investor base that's going into our fund is actually over 85% concentrated in family office capital. So managing massive families across the globe. We have folks down in like Monterrey, Mexico, or in Singapore, or in Ibiza. We have investors out of Ibiza. We really like to get to know the family businesses a lot. I mean, we could have gone that very traditional, larger institutional pension endowment route, which might be something we look at for future funds. But for now, we've had a lot of success raising 4 funds with over $1 billion in assets under management by raising money from families. So that's the biggest concentration. And then when it comes to that duration to like an IPO, it's usually about 2 to 3 years out from an IPO is where we're targeting.
So I have 2 questions then. So are you just what you're describing by providing liquidity to employees and earlier investors, that's secondary market, right?
That is definitely typically classified as a secondary market investment. That's right. So
all right, can you explain what that is and then talk about what the process is? Your exit always the IPO, or does it go longer than that? How does that work?
Yeah. So here's how I like to kind of break it down. So when a startup, right, goes out to raise a round of funding from big investors and you hear about it, they're doing an issuance of new stock to those investors, right, at a big new valuation. They call that a primary issuance. So the new shares are being issued and the valuation goes up. Where we're typically investing. Now, don't get me wrong, we'll do those primary investments as well, but that's 20% of the time versus 80% of the time is doing secondary. So instead of a primary, we're investing in secondary. So the stock has already been issued, right, to other shareholders, and we are choosing our entry price for that stock. What does that mean, right? So a company might have raised at a $10 billion valuation in the peak of the bull market in 2021. And we say, listen, the market has shifted, public comps have come down. We think on a relative basis, this stock is really priced at let's call it 30, 40, 50% discount relative to where you raised that round of funding, because that round of funding you raised was predicated on your growth, meeting or exceeding what you were doing at the time of that fundraise. And the world just looks really different now. So that is a secondary kind of issuance of stock. And then you asked your question around like our holding of the stock as investors. Similar to many venture capital firms, once the company goes public and there is a lockup of the shares, typically for the types of companies we're talking about, we then do typically a distribution in kind to the investors in our fund, meaning that they receive the actual end shares on a delegated basis amongst their investment in the vehicle or the fund. And that is considered a non-taxable event because it's treated as an in-kind distribution.
Interesting. So when you get to a level of how long has Manhattan Partners been in business?
About a decade now.
So when you get to a level of your success, do you just sit back and do people come to you and make pitches, or are you still out hitting the pavement trying to find the best deals?
So the best deals, even in today's market, are very much so still competitive, right? And I think where we don't really bump elbows against the big bad, firms of the world out there is that we're never going to compete for a board seat on these companies. Like, we know where we sit in the food chain, which is that we're going to be helpful with really the structuring of these. These transactions, I'm definitely speaking to them at a very high level around conducting secondary and working with the executives, but there's a lot of tax, audit, and legal that could really support a company or mess up a company in the future if they do these kind of secondary transactions in the wrong way. So we have all the acumen, experience to like help them get it set up, and so it's very advantageous for the company. That's our value add. So when it comes to like the competition, I'm not fighting Sequoia Capital or one of the other major hedge funds, for that allocation in the round. I'm letting them lead the show, and if we are invited to participate, we are humbled by it.
All right, if you get bored with this, let me know, because I'm going to drive this secondary market thing into the ground.
Oh, please.
Because I'm just fascinated by it. So when I imagine like somebody that works for you, like hanging around like cafeteria or a restaurant near a company that you want to invest in and go, hey, that's the CFO, go see if you can tap on his shoulder. What's the process like of getting, for example, employees? Obviously, there'd be a lot of employees in certain types of situation. It would be like, fuck, I'd love some liquidity right now. That would be awesome. You know, I've got bills and I've got a kid or whatever else causes it. Number one. And then go ahead. I'll ask you the next question after this.
No, it's okay. So in 98% of instances, right, we're talking about these venture tech, 0 to 100 in a very expedited timeline kind of companies. We're not talking about the slow growing, 20, 30% EBITDA margin businesses that are going private equity route. We're talking about the high flying companies, which, overall, what they all signal to their employee base is that they are expected to achieve results of their peers at a very expedited, rate. So these employees are kind of pushed to the limit. They all work incredibly hard. Some of them get vastly underpaid when it comes to like their kind of cash compensation, right? So a lot of them, you're right, like their equity is super tied up in the startup and they would love to get some liquidity. At the end of the day, in 9 out of 10 startups, they have really strict kind of governance restrictions that says the company itself holds the keys to how these secondary transactions go about. So even if I do meet some, VP of engineering, let's call it, like at a cafe or a restaurant, I still have to get the support, and I work with the finance and legal teams within the startups to get these transactions through the finish line, because if we don't get their support, at the end of the day, those companies could block them entirely.
So therein lies the transparency, right? Because that was kind of my next question. Like, is the secondary market, when I think of a market, Jimmy and I both came up in the futures markets in Chicago and then expanded from there. And one of the things we always bragged about with the futures pits, which you can tell by our mangled physical appearance that that's where we're from, is because we price transparency was always the big thing. So is a secondary market transparent in the way that Jim or I would think of transparency, or is it transparent in such that the company knows what's going on? And then does any competitor, it doesn't seem like you might have a lot of competitors, but there's got to be a couple. Do they come in and say, hey, MVP, which by the way, that's so cool. I just caught that. MVP is going in to do this at, say, Twitter. We got to get in there too.
Yeah. So overall, the volumes are not nearly as high, right? In terms of like settled trades that you would expect in futures markets or other forms of just exchange volumes, right? So you do have to understand that. You have to understand there is absolutely, for the high flying startups, there's enough trade volume that I can actually go in and amongst those of us who play the role of, principal investor. And actually what's very unique about the MVP model is that we wholly own a broker dealer within the venture fund management company. So what does that mean? It means that everyone on the team is registered as stockbrokers. And we could, obviously with all the kind of checklists and marked boxes, is that we can actually act as stockbrokers of these shares of private companies, and we do. So it's actually an entire business line for revenue generation under the firm. So we actually do see the equivalent of what you would call like an order book with volumes every day, but it's just not nearly the same level of volume that you would expect to see in any other asset class.
So, okay, I want to branch the discussion into a little bit about AI, because it's all technology companies that you guys are investing in, right? And so the questions become, are we at peak AI? Are we not at peak AI? And one of the reasons I'm starting to think we are is just 2 nights ago on the local Chicago news. I can't remember which station it was. My wife watches it because it tends to make me want to puke, but she keeps it on. And they did a whole story about how these people are creating essentially romantic AI partners. And never once did they mention the fact that these people are absolute lunatics. They were just talking about the AI. To me, I look for things like that to signal perhaps we're peak AI. Are people chasing it? Are you still, do you believe it's the thing that changes everything or not?
So I would say that we definitely think that the biggest kind of disruption we'll see within AI is services, businesses, and kind of disruption in some of those kind of gig economy workers as well that are providing end-to-end kind of consumer facing services, and doing that at scale. So whether that's like your chat bots or your, hire an online virtual assistant, hire a consultant. I think that's where we're going to see the biggest application of AI across the board. So I think generally what is important for us as investors, and as I kind of look to the landscape, is what, as a startup, as a tech company, are you building that's actually kind of proprietary, or are you using all these various kind of plugins, right, from other bigger, more established players in AI to supplement your existing business and make it more efficient, faster, and increase your margins, right? Like, this is natural. If you look at a balance sheet, where's the company spending money? Is it that they have a bunch of service workers that are fielding customer support questions all day? Or is AI going to be able to supplement that kind of activity? I think that's really important for a distinction. And also, AI, as of right now, is only as good as the information it is fed. And so I think that's what's incredibly important. Is I'm not even remotely touting myself as an expert, but if I see content that was written by AI, I actually could typically distinguish it pretty quickly. There is a cadence to how things are written that makes it very transparent for those of us who are looking at like the language models of AI. So I would say it's going to be supplemental. I don't ever see it a displacement. AI in the terms of like romantic stuff, that does freak me out a bit, because that means there's like emotion that is being trained into the models, that definitely
crazy.
scares me.
Yeah, no doubt about it. Okay, so one thing you are an expert on is valuation. And we're talking about AI, and you look at a company like, and again, she talked about being licensed stockbroker. My licenses are all in futures markets. So for my lawyers, Stacy, Mark, Margaret, George, I am not recommending any stocks to anybody here. You look at a company like NVIDIA, which was trading, I believe, at 35 times revenue when just recently. Do you look at that valuation and scratch your head and say, what in the hell is going on?
Well, someone's got to build the chip processing for all of this compute power to exist, right? So I think NVIDIA has always positioned themselves as a company that has the capacity to build chips at a pretty high velocity. And I think with that powering capability is like, if you're looking at the future of what level of compute needs to exist to support the level of search queries that are happening and what is being expected and projected for the future of AI, I think that's where NVIDIA has come out. I mean, just in layman's terms, they come out and said, we're ahead of the curve in terms of manufacturing capability. And so we are here to support this next generation of compute. And it's with our technology. So, I mean, that is the positioning that I just see them come out publicly with. That is a company that's always ebbed and flowed, but overall, I think the right time, right place is always the message when it comes to which companies are harnessing the technology of today versus kind of building the technology of the future. And NVIDIA is, saying that that's where they're sitting in this landscape.
How do you feel about Elon Musk's interpretation of AI? I mean, I'm not saying you know him personally or don't. You certainly can't get in his head, but you are. I hesitate to say you're invested in things because I don't want to put words in your mouth, but you have in the past been involved with his companies. Do you look at stuff like that and think he's nuts, he's accurate, or are you just focused on the investments and that's it?
I mean, are we sure Elon isn't AI himself at this point?
That's the best answer, by the way.
No, we're not sure.
Are we sure? I mean, how is the guy how is his finger in so many pies all at the same time? That is the big question, right? Like,
certainly his personality isn't fully developed, so that could be a sign.
I think that where I see, I think Elon likes to kind of course, we all know he takes a very sensible approach to being provocative, is how I'll say it. So for him to kind of perpetuate the fear side of AI is interesting. And I don't know, is that something that we want to instill in the eyes of consumers? I mean, I think Elon at this point loves to effectively just troll everyone in regulation, because he completely takes the stance that he is above and beyond the need to, fall back to regulation, because it just isn't working at the speed of his brain. So I think some of this also stems to the fact that the regulators went from, scrambling on crypto and exchanges, and now they, suddenly have to keep up at a much faster clip for what's going to happen in AI. And can you imagine, how AI will be used as, I don't want to say a crutch, but a crutch when it comes to what the future of like finance will look like too, right? If people with banks could fall back and say, we didn't do it, the AI did it, right? I can only just imagine where that's going to go. So I just think that kind of scramble of keeping up with the pace of what's happening in AI is fascinating. I'm definitely all for the ethics and standards across the board, but I think that there's so much rapidly new application of AI coming out every single day that I don't know, how swiftly a governance kind of protocol can get put in place that would be applicable to everything being built right now.
I want to shift a little bit, but I did mention, I'm sorry, Jimmy, did you want to say on the subject real quick?
No. I thought you're up, Mike. That's fine.
Yeah, no. So what I was going to say was I recently signed a property easement generated by AI, which I thought was really interesting. I mean, I called my lawyer, called him. He didn't get back to me. So I generated it on one of the language models. And my neighbor said, this looks fine to me. I said, looks fine to me too. So we signed it. And, it's interesting because then I finally talked to my lawyer. He goes, yeah, I'm starting to lose little jobs here and there. He goes, I'm not blaming AI, but I'm raising my prices on other stuff. So you're probably right to do that. And it was interesting. I don't know if that was a short-term inflationary component, deflationary. I haven't figured it out yet. What I was going to shift to is because you mentioned Coinbase and you mentioned the SEC. And I think all three of us kind of smile when we talk about the SEC and their inability to do what I think they're mandated to do, so to speak. How do you feel about what's going on with that? What's your take on the SEC going after Binance and Coinbase the way they have?
Yeah, this is an absolutely fascinating topic because I don't think any of us are necessarily surprised, right? If you're sitting in the world of finance, you're like, okay, we've seen this play out before with various form of financial instruments over time, right? And everything is cyclical. But I think where this is just absolutely crushing, I do worry about like the future of the trust in crypto and stable coins and fiat and really the is regulation going to kill something that was only really initially started for the supporting decentralization and democratization? But overall, I mean, let's talk about it. So Coinbase and Binance both effectively just got massively slapped because the SEC, after much digging in, said, you guys are operating exchanges when they are not registered exchanges. And you've been claiming to the public that these are regulated stock exchanges for years. You're providing settlement, custodial support. Like the SEC was like, we never actually gave you our blessing. Not that, by the way, we all know the SEC doesn't really technically like to give anyone their blessing. They like to say, oh, we're gonna, be neutral, but we're not gonna say yes, we're not gonna say no. It takes a lot for the SEC to say, we're not at all giving you our blessing. And instead we want to shut down operations, right? So I think where some of these companies in this space did it right, others did not, is they at least tried to be as transparent as possible with the various businesses they were building. Staking, which is a form of lending, the exchanges itself, the coins they were listing, were those actually securities? Were they not, right? Using the Howey test to evaluate whether they were securities, were they not? Overall, like my take on it is, I think in hindsight, as I kind of dug in, even further over the last few months on all of this, is it probably would have been more wise for some of these companies to segment their businesses a bit more and operate certain aspects of it, like their exchanges, in other geographies, other jurisdictions, and keep certain businesses in the US and then park some of that stuff in Bahamas, Cayman, or otherwise, and keep it all very siloed, versus rolling up and co-mingling a lot of that business activity together, which is, I think, very much so like a startup way of doing things, where it's like, oh, we'll just build it all together and apologize later. That's just not how the SEC likes to act.
Andrea, why did they let Bitcoin and crypto go for so long? For years, I've been arguing that our government likes to control everything. They certainly don't like anyone stepping on their turf, which is, the issuer of currency. But they let it go for years. It baffles me. Do you got any theories on that?
I don't know if they had have a choice at this point. Being able to call back.
No, but they had a choice 6 or 7 years ago, though, right?
Yeah, but back then it was that the banks were in their ear saying that they might want to put it on their own balance sheet and leave it alone so that, Jamie Dimon could sit back. And back then he was the biggest proponent of saying, oh, let's build on crypto and blockchain and blah, blah. And then all of them kind of took a 180 at the bank level, right? Because what they also said, right, is that, oh, well, the value of crypto is inversely related to the value of equities, but that just proven not to be true. So I think back then, like I said, I think the banks were really in the ear of the regulators and said, let's watch this play out a little bit. But now that the store of value in crypto is not there. And so the banks are like, this is no different than any other asset for us.
That makes sense. And I actually think, probably it's too late to extinguish it now. I mean, China made it illegal and mining in China increased, not decreased. So Let's see what they can do. Can we shift for a second? Because one of the things I'm interested about your business is its glimpse of macroeconomic conditions. You said 85% of your funding comes from family offices. If people believe that a recession is on the horizon, do you see that quickly? Do you see that in people trying to get money back, people not investing as much as before?
So I think this is fascinating because we love to dive deep on the macro across all aspects. And you're totally right. That kind of trickle down effect certainly will impact and always has equities and the public market first. And then the next kind of tier below that is late stage venture, because those are the next crop of companies that otherwise would benefit from prosperity and liquidity. I think what we kind of discuss internally is that, the definition of a recession that has been so clearly historically defined as like certain leading and lagging indicators, like those just don't align, because I think the pace of job creation, especially during the pandemic, was at an all-time high, but now it's condensed. And it's hard to call things a recession cut and dry, black and white, the same way we used to. So I think unless, we all just kind of come to a consensus that we need to change what the, defining definitions of lagging and leading indicators are, I think we're all just going to be across the map right now. I think that general investor sentiment is absolutely, definitely skittish, much more skittish than it ever has been. People do want liquidity, but where we see the desire is the de-risk of assets, and the more cash you have on the balance sheet. I think a lot of companies that are strong performers, they're controlling their balance sheet and their spend. If they want to cut back on sales and marketing, they cut back on sales and marketing. And they want to raise their EBITDA margins, into profitability, they can. And those are some of the best companies operating out there. And again, this is where like that play into AI is really helping companies who are signaling that, hey, we're going to increase our margin profile because we're about to wipe out all of our customer support workers, for example, because AI is just going to come in and take over. That is helping earnings calls. That is helping stock prices. So generally, I think from a macro perspective, we're seeing that. I do really worry. I'd love to know your guys' take. I really do worry about inflation and consumer spend, because I think that companies are just absolutely eating into what is now, an overinflated narrative that their spends are up so that they have to increase the price of their goods so much more. I think I saw that the price of Pepsi products went up 20% over the course of 2 quarters. Yeah. And it's like that hits the end consumer really hard. I really worry about that.
Well, in my restaurant, our costs, I have a restaurant, Brant's Palatine. If you're ever in the Chicago area, I think you'd love it. Particularly, it's an old gangster joint too. So being an Italian might make you like it more. But anyway, our costs in 2.5 years went up approximately 35 to 40%. We raised our prices 25% because we're in a little different situation than some other restaurants are, that we could, withstand the winds a little bit. Yeah, but we have no intention of sending those back down. But to your question, I think you're going to get different answers with Bobby and I. I think the worst of inflation is over. I think it was terrible. I don't think prices are going down, like I said, but I think there's a couple things. High prices have historically been a cure for high prices. And the fact that the government is no longer just injecting money into people's checking accounts and letting them spend it willy-nilly, at least that's done. The government is still doing a lot of bullshit things where they're spending way too much money and weakening the dollar. But I think the worst part is over, and now we're just about to start to feel the efficacy of the Fed rate hikes. Bobby, what do you think? You think inflation is about to rear its head again, don't you?
I do. Well, first of all, I mean, we got inflation still well over 4%. So it hasn't ducked its head so that it needs to rear it again, right? I mean, this is a course going with the Fed narrative that for some reason, 2%, what they completely pulled out of their ass however many years ago, is the right number. You know, I maintain with everybody that we all use this word recession, which if you look at stocks historically, the word recession doesn't even matter. You should welcome a recession. Because stocks start to go up a little bit into the recession, and then they follow in through the end of the recession, and they usually start new small bull trends. So like a recession is kind of a welcome thing after the kind of bull market that we've had, the way that I view it. So I don't know. I mean, people get afraid of it from your sort of Main Street mom and pop, and I get it. But from the perspective of inflation, the services inflation has been stubborn as hell. And the other part about it is we had the supply chain heal itself to a certain degree. Now we got the strike in the Long Island ports. I don't know if that's going to be long or if it's going to do any damage at all. But energy is the first place where you're going to get another spike in inflation if energy spikes. Now, crude oil is not, but we're not fully into the summer driving season yet. OPEC just cut again, and we're not even talking about what could happen to natural gas going into Europe this next winter, which they haven't even started to stockpile that stuff. That's two. Number three, financial conditions as represented by interest rates have tightened. But I just looked today at the Chicago Fed's financial conditions index. It loosened again. So you don't have loose financial conditions. And Jimmy, I agree with your Substack that you wrote that was not a good non-farm payrolls number. That jobs number was not good. It had a good headline number. When you dove deep into it, you had wages that rose at a slower rate, but still rose. Credit card applications up, delinquencies up, delinquencies on auto loans up, late mortgage payments up, not to drastic levels at all, but they're all up. So we have the potential for the consumer to kind of fall off a cliff with inflation at 4%. You either get a recession or you get high inflation. I don't think they've never engineered a soft landing, and I don't know why this would be different. You know, and that's sort of my stance on it. Like we're seeing the inflation pushed further and further. I'm sorry, the recession pushed further and further back, and I'm still in the recession camp. So if the recession isn't coming, then inflation is staying. I don't see how it's not both. Is it the Inflation Reduction Act? Is that what did it, Jimmy?
Is that what cured the inflation? Oh, I'm sure it did. Yeah. See, Andrea, just to give us a little glimpse of us, we think the government is a bunch of babbling buffoons. The notion, the fact that Jay Powell in June of 2021, when CPI printed over 5%, the housing market was inarguably on fire. They kept buying bonds for another fucking year, another 250 billion, just mortgage-backed bonds. So we don't have a lot of respect for them, and we believe that they will only possibly can overdo it on both sides because they use such a blunt instrument. Are you with us on that?
Oh, absolutely. It is just the lack of diversification across the government to say that we're going to go back and do mortgage bonds. It's insane to me. Like everything about it, you know. And by the way, that whole weekend, you guys, I mean, I come from Bleeding Heart, Silicon Valley all day, and that weekend Silicon Valley Bank went down. I don't think I slept for 72 hours. I mean, that was, you know, and it just, we all kind of smack ourselves in the forehead and say, why didn't any of us kind of look into their filings? Like this was something we all could have predicated with the raise of interest rates very quickly. Now I am, you know, on the other side of it, though I am incredibly biased, even though it ends up being a great outcome. I've banked for 10 plus years with First Republic Bank. And when that started going down, I'm personally offended by it because I was like, they're strong balance sheet, they're diversified, they are not SVB. But now we're all under JP Morgan. So I was like, actually, this is a pretty solid outcome for all of us. But
it's interesting, if I could, Jimmy, I actually want to throw this to you, Jimmy, if you don't mind. One of the things, Jimmy and I have been having this argument back and forth, and he's been right that the recession hasn't come. He's been pushing back on me. I maintain that's like saying in 1966, it didn't snow in Chicago until December 28th. It still fucking snowed. You know, I mean, it's just one of those things where you know it's coming. It just didn't come yet. But Jimmy's been right on the recession. And I would argue that I've been right on inflation, but that's not fair because inflation actually never goes down. If you put up the CPI, the only time inflation does go down is in a recession, which is why I say you either have a recession or you have inflation. You're not going to get a soft landing. So to Jimmy's point, when you're looking at it, one of the things that keeps us, I think I know Jimmy talked to this. I am kept awake at night wondering if it's stupidity or if they're just nefarious. And
Well,
go ahead.
let me answer that first. I think there's absolutely, it smacks of being nefarious. There were 5 states that absolutely could not pay their bills unless one thing happened: rampant inflation, to increase their tax receipts, to monetize their debt. And I'm not even talking about, I'm talking about obviously the state that I'm sitting in right now as well, but counties across the board, all the poorly run, highly indebted municipalities and states needed to be bailed out, or else we were going to have an awful problem. Andrea, I'm going to ask you. To me, it seemed like they told us for 10 years that they wanted inflation, and then they all of a sudden were like, wait, we got an opportunity to get it. Let's just shove $7 trillion into the market, lower rates to 0, and see how this all plays out.
Absolutely. And I mean, then there's the corporate benefactors of this tied to municipalities who are like, well, let's squeeze the lemon for as much as we could juice it, right? Why not? It's a perfect storm of a story that says, well, we suffered with supply chain and inventory and manufacturing during the pandemic. What's to say that isn't still the case? Right. I mean,
and Japan, to put a finer point on it too, Japan basically came out and said it, like, we're going to take this opportunity to shake the shackles of 15 years of deflation, or however the hell long it was, and we're going to get this going. So why do people like our Fed and our government's like, gosh, wish we could do something about this inflation? You did something about this inflation. You caused it. But yeah. So I do have another question. Similar to, so now you look out. Bobby said recession. I actually think recession now too. What do you think? Do you believe that the inversion of the yield curve is telling us recession? Do you really think the Fed is going to be easing at the end of this year into next year? What do you see?
I see much more. I'm leaning much more towards recession than I am not. I don't think I necessarily, I don't have faith in the Fed to ease anything. I think the debt ceiling stuff is absolutely incredible for those that are benefiting in regulation across the board. I mean, I could go deep on whatever you want to do, but I'm leading more towards a recession. I don't think the housing market windfall has even remotely scraped the surface yet. I think that's a big domino that we are all kind of waiting for. Sure, we're seeing where the government sits with their mortgage bonds and everything else. But I just think down at the consumer level, mortgage payments are not there. People who took out their second mortgages, it's a struggle. I mean, I don't know. That's where I am kind of all eyes on where does housing sit over the next 6 to 8 months.
Okay, so here's my question to you. So based on my high level barroom napkin calculation, talking about M2 money supply and liquidity injected into the system. Had we stayed on the same path of money creation that we were on from 2011 until 2021, which was ridiculously steep, by the way, had we still stayed on that same path, we'd be under by $2.5 trillion of where we are now, even with the 4.6% unprecedented pullback in M2 money supply. So there is a question here. I'm not just ranting, which, by the way, I am capable of just ranting without a question, but this is not one of those times. So we've seen 4.6%
particular case.
This not particular time. You mentioned housing market. Now I'm going back to your business as well. Is there excess liquidity that's still in the system? Still a huge, where does it have to come back to for you to start seeing a crunch in your business, a crunch in the housing market, crunch in the stock market as well?
I would say overall, where we see the crunch happen, right, is if the yields across the board come down at a double or more rate, generally across. Overall, like the bond market, we assessed was strong enough to keep people satisfied and have enough liquidity in the short term, but overall. Generally, when you got a cash generating business right now, people are still reinvesting it. I'm not seeing that, investors are sticking it under the seat cushion full bore. I think that's what would start worrying me. There's still enough advantageous upside necessarily. And of course, disclaimer across the board for my compliance team. It's not like I'm suggesting stocks or to invest in one thing or another, but it's that there isn't a fear monger across the community that doesn't say, oh, the upside is no longer there. There's still ability to invest in alternative assets that have short-term duration, high enough yield capability that taking some risk right now still makes sense, more so than just hoarding cash. Just my impression.
So at what level of the safe rate? Like I always argue with people when we bought the restaurant in 2013, interest rates are zero. You got to find yield somewhere. Some buddy of mine came to me with the deal and it looked like pretty good. And it has been pretty good. At what level of interest rates do people stop investing in your fund and just say, well, shit, I can just get, is it 7% on a US Treasury? Would that interfere with your business?
Your
I mean,
face
the
is
thing-
perfect, by the way. Go ahead.
The thing is, the majority of our capital is outside the US also, to be clear.
Oh,
So
okay.
yeah. So I've got more international investor exposure than I do domestic. So I think that's what makes this a little bit difficult, is that I'm looking at like global macro and where will, headwinds shift from like a GDP perspective. And then, where do they stop investing in US investments relative to their own geographies? And as of right now, it's still that the dollar is strong enough that international investors, in most geographies are like, well, it still makes sense to have assets in the United States. That's where I see it. I don't know if it's necessarily a direct correlation to, for my business, just some threshold of interest rate size. So that's what makes it difficult.
All right, so given that, this might be a weird question to ask you, but I see the dollar just getting stronger simply because I think that the ECB is going to crack. I'm just looking at the euro. I think the ECB is going to crack before the Fed. I really think the Fed's going to hold rates longer. And just with the rate differential, I think the ECB is going to crack and the dollar is going to climb back up. As a matter of fact, when I look at longer term charts, I've actually got patterns that say that as well. So what do you guys feel about that MVP? Do you think that's the case for the next, 3 months to 3 years?
Yeah, if we're looking at, FX across Europe, as you said, the euro, and then where I'm seeing in like Latin America, it's still that the US dollar is the strongest store of value across all of the international currency. That just relatively, right? It's able to hold strong. So I think generally as long as we see that persisting, I'm more positive than I am negative on the ability for international investors to say there's enough jurisdiction for them to keep dollars parked in the US. There's enough yield for it.
Let's expand into FX then real quick, because I keep hearing rumblings that the Chinese, what did Hugh Hendry call it, Jimmy? He called it
the red cabbage.
That's what he called it, the red cabbage. The Chinese yuan is going to be the reserve currency like next week. Okay, thank you. You don't even have to answer now. I was just wondering you,
because it's asinine, right?
I had a friend who's a banker in New York. He's worked at a lot of the big banks doing funding, and he said to me, "It's like, why is everybody talking about this?" And my answer was, because they're idiots. So I didn't have a better answer than that. So what's your take on that?
We're all just lucky. I don't know if you guys have spent a lot of time in Asia. We're all just so lucky that Greater Asia, China, effectively just stifle themselves time and time again, because their economy is such a multitude larger than ours. I mean, they are a powerhouse of a nation and an economy. And quite frankly, their businesses in China can absolutely self-sustain fully, growing at typically 4 to 5 times larger than their US counterparts without ever entering the US market. The problem is that at the top, they continuously push themselves down and want too much power. I mean, I'm keeping this very high level, but it's just, if you look across the board, I want to just emphasize, I think my favorite example of what we're all describing here is that, I don't know if we all remember, but a couple years ago, the biggest IPO outside of, there was Saudi Aramco, right? That's one thing. And we could talk all about Live Golf and PGA, because now we're really seeing the impact of Saudi capital come out. But beside the point, if I go back to this, the biggest IPO in world history was supposed to be about close to $800 billion in market cap. And it was supposed to be Ant Financial, which was the financial arm of Alibaba, still operating as a business. They gear up for the IPO, going to list in Asia, biggest IPO in world history. The day before the IPO, they pull the plug at the state level, and Jack Ma goes missing on a 6-week yoga retreat. Like, are you kidding me? You know, and people wonder why, you know, most Chinese investors don't even have their cash in China, right? They are all of it is stored in Hong Kong, overseas, in Dubai, in Singapore, or in Cayman, right? So I think just generally, they don't help themselves by blossoming their own economy. There's just way too much government level interjection.
So the question then becomes, is who do you trust in counterparty trade? If you're going to hold the yuan or you're going to hold the dollar. And by the way, this really irritates me because I just see very poor stewardship of our own currency on our domestic shores. But then as soon as you compare it to all the other bullshit that's going around the rest of the world, you're like, yeah, pretty much the dollar is the only thing left. And I think that emboldens them to do that crap like MMT. And still, you know, the Stephanie Keltons and the Warren Mosers of the world are still holding their head high saying, we can do MMT. It's no problem at all, despite the fact that we had 9+% inflation. Any thoughts on any of what I just said, or that was just a rant, probably, right?
No, it's true. I mean, to me, it's still US dollar all day. It's US dollar. And it's also, what is the governance of like the underlying investment, right? Is it governed in the US? Is it governed is it governed as a VIE, which is like the offshore structure that a lot of Chinese enterprises are structured as? Is it Cayman? Is it Switzerland? Is it Luxembourg? Like, all of these things really matter alongside the currency, because at the end of the day, if things hit the fan, you know, whose governance is going to dictate the like distribution of assets in a bankruptcy, for example, right? So I can always convert my dollar. I can always convert currency to dollar and otherwise. Of course, I'm going to take a hit when it's outside of the dollar. But if I'm going to convert into US dollar, that's a good bet for me to make.
So let's go back to regional banks, since you brought it up. Friends of mine, and one I'll mention because he said it on the podcast, that's Hugh Hendry, friend of ours, friend of the show. We don't really know him. But also Kamal Shri Kumar, who's an economist on the West Coast, has been on our show a couple times. And both of them, along with some people I know personally, think we're not even close to the regional banking stress being over, simply because of balance sheets and some of the investments. We haven't even talked about bad loans yet. What do you see, if anything, and does it worry you?
It does worry me because I do think that regional banks over levered themselves without enough diversification in many instances and played with fire. Customer deposits aren't as strong across the board. I don't care what kind of bank you are. And generally, you know, I think that there is, just to be clear, it's not just about that kind of the balance sheets overall. Unfortunately, you know, if you kind of put together a bunch of CFOs right now across the room and say they're you know, banking CFOs, both private and public, a lot of these guys are kind of kicking themselves because they all spent the last 3 years putting ESG in you know, incentives in place, where they had to comprise their boards of directors and boards of ethics around ESG and diversity. And quite frankly, you know, it's one of the kind of things that people talk about in Silicon Valley is like Silicon Valley Bank had one of the worst risk assurance and risk compliance teams across the board, because they had to have some very specific diversity mandates. And it was just like, they spent all this time worrying about diversity and not enough time on the fact that they were over levered. And that's actually perpetuating across the banking industry. And to me, that's very worrying, right? That is a deflection of reality. And there's way too many people's heads.
I'm so frustrated right now, because if we knew we could have got you on this path an hour ago, we would have punched the shit out of these people for those diversity quotas for the last 50 minutes. So that's why I was going like, oh shit, she's one of us, right?
That's actually, it's funny. It's one of the things that Kamal said. We couldn't get even Kamal to say darn it, let alone talk.
He's the nicest guy.
Such a sweetheart of a guy. but he did say that he blames the Fed. And he's very critical of the Fed. And he said, because imagine you're a bank and you're sitting there planning conferences and not worried about risk because there's no inflation and there's going to be no change in yield. And then you see inflation and your regulator says, don't worry, it's transitory. So you go on and plan more conferences and you don't worry about risk management. I thought that was an interesting take on it.
I mean, so you're spending in sales and marketing, and you're reducing spend in risk compliance and oversight, which is just, I mean, completely baffling to me.
Honestly,
right? That is,
guys, Jimmy, we should be calling around all the banks and saying, "Do you need a hedge?" Jimmy, because I mean, in his office tomorrow and do the hedge in 5 seconds.
Right. It literally would take, Bobby and I, who do, I mean, you too, I'm certain, but we do interest rate derivatives. I do this for banks. I could 5 minutes, you could tell me what your exposure was, and by 10 minutes, we'd have it all worked out. That's what the futures market, the interest rate part of it is. So that's why it's particularly frustrating for guys like us. I do, and I always bring up Royal Bank of Canada, who, they had the most unbelievable risk controls, and I don't know if they still do, but it was fabulous because the people I would talk to there would give me a call and be like, "It's such bullshit. I have to hedge this." And I'm like, "I love when you have to hedge it, pal. That makes me money." So like, your risk manager is my favorite guy in that whole bank. But it's not that hard. You spend a little bit of money, but it's cheaper than bankruptcy.
Oh, it's a lot cheaper than bankruptcy. And I mean, I don't think we've even seen the all the side effects yet. I mean, Silicon Valley Bank still has functions of their business that are for sale and are being flipped at this point in time, right? There are still segments of First Republic that are being assessed and determined whether they're going to be swept up under JP Morgan. I mean, overall, it's, we all love when we see the Fed come in and say, "Oh, don't worry, we saved everybody, no problem." And now they have a buyer. It's not that simple. There are still assets that are looking for a home under these bankruptcies. And there's still a lot of open questions around people who have accounts at some of these banks in terms of whether or not they're going to be swept under the rug, or whether they have a home, whether they have to move. I mean, it is a mess to see some of these regional banks go through a bankruptcy.
Okay, then the last thing then. So it sounds to me like you're saying, and then we'll wrap it up. I know you have a life to get back to too. Are you going to the beach today or anything, by the way, or no?
I did actually do that already today. So
that's fantastic. Good.
Yes.
So you're saying that the fallout we're seeing, one from the regional banks, is not even close to being over. That recession is probably on the horizon. Those are the two things that's accurate to quote you as saying, kind of.
I would say so, but I do have to agree with you both. I see the perspectives of recession or inflation. I don't see an end in inflation. I actually just see profit margins being squeezed. I'm much more in the, like I told you, I'm in the camp of like just being very worried about end consumers right now.
Okay.
Yeah.
Bobby's okay. I have to do every time you do Maria Bartiromo's show in the morning, you have to, the day before, you have to do a screen test.
Yeah.
Where they, you notice that too? So in 5 minutes, they're going to call me to do a screen test. So they know I know how to operate a camera for 5 a.m. tomorrow morning when I do Maria's show.
Do it. Like that's the last.
That's what I mean. Like I'm always from the same spot. It's at 5 a.m. I'm not going to be anywhere else. It's generally where I am at 5 a.m, unless it's been a really bad night. But anyway, you got anything else to say, Andrea? So, by the way, thank you so much. I think this was a ton of fun. I love learning about a business that I don't know that much about. I thought it was great.
I'm happy to know if you guys, we can have a whole other segment on macro predictions, and I already know that would be even deeper. We could go.
Oh, I love that. We should do that soon, actually, because that's what we prefer. Like, I wanted to learn about all your business, but in normal life, we talk about macro shit all the time.
100%. Yeah. So we'll have to plan accordingly. But no, this was great, you guys. I so appreciate it. This is amazing.
Yes. Thank you a ton. I'll see you guys.
All right. Thanks so much.